Okay, good evening, everyone. I see folks still are joining, so we will get started here shortly. Looking forward to this evening. All right. Well, thank you all for taking some time out of your busy schedules this evening to join us on tonight's webinar. It should be a great opportunity for us to impart a lot of recent information going on inside the dental market that you all can leverage for yourselves as you're planning an eventual exit. So couldn't be more thrilled tonight. There is an opportunity for you to submit questions during tonight's webinar, and we will get to those time permitting at the end. So please don't hesitate to drop those in. If we can't get to those on tonight's webinar, we will absolutely follow up within 24 hours via email to answer them directly, or perhaps set up a call to discuss things further. But with that, let's get started. Okay, I'm your host tonight, Ryan Mingus, Managing Director and Partner here at Tusk Practice Sales. I've spent the entirety of my career in the healthcare field, specifically in business development roles, management consulting, and mergers and acquisitions capacities. I joined Tusk about 5.5 years ago and have had the great pleasure of watching our organization grow and watching, quite frankly, the dental industry continue to grow and mature and work through its natural cycle of consolidation. And tonight's webinar is really just an opportunity for us to let you all know how you can capitalize on that. I'm also joined by my colleague, Connor Jorgensen. He's a director here at Tusk and oversees all of our business developments and kind of prospective client education functions here at Tusk. Couldn't be happier to have him on the team a few years in at this point, but he spent the entirety of his career in the dental field, starting at Patterson Dental, and ultimately, before joining Tusk, worked at Imagine Dental Partners on the buy side. So we sat opposite of Connor in our processes for a while as he was representing that DSO in their acquisitions process. So couldn't be happier to have his background and expertise on our webinar today.
Thanks, Ryan. Definitely excited to be here and looking forward to the conversation tonight.
All right, thanks. We'll hear from you later this evening. For those of you that aren't familiar with Tusk as an organization, it's always good to get a quick overview. But we represent clients all over the country. So nationally, you can see that footprint up there, all the deals that we've done within the dental industry to date. We've got over 125 years of healthcare industry experience. We've closed over $1.3 billion worth of healthcare deals, with call it 95% of that being dental. So call it over $1 billion worth of transactions in the dental field. We've got backgrounds in investment banking, mergers and acquisitions within the private equity space, and really bring that to bear for our clients each and every time. Collectively, both at Tusk and prior to joining Tusk, combined, we've done over 200 healthcare transactions, and we've got 14 fully dedicated team members, and we're headquartered out of Charlotte, North Carolina. Here's a quick overview of our team, starting with our founder, Kevin Cumbus. Kevin has an investment banking background, but really formed Tusk after being in the investment banking world, seeing what was going on within dentistry, specifically the entrance of private equity and the proliferation of private equity within the space. And being the son of a pediatric dentist, he recognized that he had a lot of value to add to potential selling dentists and dental practice owners as they try to combat and navigate this environment of private equity-backed buyers. They're very sophisticated, much more sophisticated than another doctor coming to buy their business. There is just a myriad of things that he noticed where he could add value, and ultimately built a firm specifically in the image of going out and helping folks just like his father that were 20, 30 years into their ownership of their practice, looking to exit their life's work and not really knowing where to start or how to navigate this private equity backed world, if that is a path that somebody might be considering. We certainly understand that this is not for everyone, And we do a great job educating people and sometimes talking people out of the idea of selling to a private equity group or perhaps a private equity backed DSO, MSO, IDSO, whatever vernacular you want to use. So Connor's the tip of the spear on education and business development. Here I work alongside him, taking on anything, if his plate's too full, but we really work hand in hand on a daily basis. I also oversee the mergers and acquisitions team. These are the folks that actually execute our clients' marketed sales process when it comes time to go to market. And then finally, Alex Chernyovsky oversees our analytics team, which is really the backbone of our organization and certainly something that I think sets us apart from many folks that advise to sellers interested in partnering with a private equity group. They've got a very unique background and have really formed an excellent reputation for themselves and our organization, both on the buy side and the QV side, which are the third party impartial with quotation marks, folks that these DSOs use when they're looking to get through a quality of earnings and get to a close. They go to the mat each and every time for our clients, and certainly would put them up against anyone in the industry and quite frankly, outside of the industry as well. So tonight's theme is really to make sure that we give you as much information as possible to allow you to skate to where the puck is going, not to where it has been. There have been a lot of activity in the world of dentistry and the mergers and acquisitions space and what deals looked like once upon a time, call it 2019. And then the drastic changes of what they looked like in 2020, and then the incredibly frothy environment of 2021. And then, there's a story to be told for 22, 23, 24, and year to date 25 as well. A backwards look is important, but history does not necessarily repeat itself. Generally, in the world of mergers and acquisitions and private equity-backed consolidation sectors, it does not repeat itself. It actually runs in multiple waves and they all end in a very different place. So we will look backwards because it certainly will tell a bit of a picture about the future, and we can take things from that and dispel a few myths and perhaps misconceptions that you might have or the folks have about the industry. But our goal is really to give you an outward looking view on how you can address things within your business today or between today and the time that you ever enter into a process of going to market to sell your business, that you can give yourself as many exit pathways as possible, knowing that there are trade-offs, benefits, cons, drawbacks for each and every one of those. But what we don't want is somebody to be pigeonholed and only have one opportunity to exit their business or one pathway to exit their business, when we can give folks information today that will give them a multitude of options when that time comes. So that's the theme for this evening. I want to start with kind of a very basic principle of why is private equity interested in healthcare and dentistry more specifically, and what are their goals both strategically, economically, for themselves as the kind of the platform owners, as well as the limited partners that they took capital from when it came time to build their platform. I think this is an important place to start each and every time and remind those that might just be learning about this industry and getting familiar and in that discovery phase, but it's also a good refresher for everyone out there as you're ultimately gaining knowledge on how buyers are thinking so that you can think like they are when it's time to go to market. So attractive quality of the healthcare, and this is more specifically dentistry for everyone on this call, but it's a fragmented market. That's something that they're looking to do. Where there's a fragmented market, there are generally low economies of scale. There are opportunities to save through scale and economies of scale. Additionally, they tend to be slightly less sophisticated because technology tends to be expensive in a fragmented market. Smaller businesses choose to invest less in technology, and therefore by consolidating, there's an opportunity for them to apply greater applications for technology. There's a very high barrier to entry within healthcare and within dentistry. So, doctorate level degrees, highly regulated environment, and pretty capital intensive to start a dental practice, to go out there and build something from a cold hard shell and move on. Additionally, you guys generally run very high margin and recession resistant or even recession proof businesses, which is very, very attractive as they're trying to seek, I guess, low risk, high margin cash flows throughout the ownership of that business. Most of the market is not optimized from, operational perspective, a marketing perspective, or a technology perspective, like I mentioned before. So they view that as, certainly opportunistic for them. What are their goals when it comes time to acquiring a business and then growing that business? So they start with raising capital from high net worth individuals, including family offices, endowment funds, pension funds, and ultimately they're known as LPs, or limited partners. So these are the folks that have stroking checks to these folks to ultimately go out and put that capital to work. They want to enter into a fragmented market, and they want to create value through scale. And they want to begin this process with a large initial platform. So they want to start with a large, chunky deal, ideally $3 million of revenue or more. They want that business to have some level of sophistication. And what I mean by that is some centralized services where they're starting to benefit from economies of scale. They've got some better purchasing power. Perhaps they've even started to leverage their scale with better payer contracts and better negotiations. They've generally got a non-clinical leadership element to the business. And perhaps they've learned how to both build a de novo business or start businesses from scratch and make them profitable in a short time period, or they've mastered how to acquire businesses and grow them and integrate them into their business and grow that way. Or perhaps they're able to do both of those things, and they've shown a track record to do that. But that's what they want to start with, because what they ultimately want to do is, take this business that perhaps has taken it as far as current ownership can take it, to call it $3 million of EBITDA, find that group that wants to take some chips off the table, but really sign up for a second or a third run at this thing, to take it from $3 million of EBITDA to $15 million of EBITDA, and then perhaps, $50 million of EBITDA on a third turn. So that's what they're initially looking for. Once they acquire that, they want to aggressively grow through acquisition. Very, very few, if not, I can only think of about 2 off the top of my head of large DSOs that are greater than 50 locations that do not grow through acquisition. That being Aspen or Pacific Dental Services, which primarily, if not solely, grow through brand new stores, de novo strategy. They don't acquire businesses. The rest of the DSOs out there actively acquire through acquisition to the tune of 13 to 20% on a compound annual growth rate. So all those limited partners that invested money, they're expecting a return on their investment of 13 to 20% on a compound annual basis. So they want to get 2 to 4x their investment in a 5-year run. And the only way that these groups can generally do that is through acquisition, which is why there's so few groups that have a pure de novo strategy. Then they want to layer in centralized services. They want to reduce expenses through purchasing power. They want to leverage technology. AI is a big buzzword. At the Dykema conference that we were at, it felt like every single vendor out there had a very unique AI solution. And these DSOs are actively looking at each and every one of those. They spend a lot of money researching and demoing these different pieces of technology, because just like you guys are experiencing difficult operating environments with hiring administrative staff, hiring dental assistants, hiring doctors, hiring hygienists, and retaining all of those folks, if there's an opportunity for AI to take one of those jobs out of the clinic, they're absolutely going to do that in order to maximize efficiency. And then they really want to have operational excellence. They want to have established standard operating procedures, or SOPs, across their organization throughout the different levels of their organization to achieve operational excellence, because that's when they'll start to see their EBITDA in aggregate really start to look as profitable as it could be. And then once they feel they've got there, then they want to iterate, refine, and then dress up their business before they too go to market. So just like you're sitting on this call, potentially looking to go to market at some juncture, we want to make sure we tell you how to dress your business up or refine or iterate on it before you go to market. These DSOs, IDSOs, OSOs all have investment bankers that serve the same function as Tusk would for you, to tell them what they need to do to their business before they take it to market, because they've taken 5 other DSOs to market in the last 10 years, and this is what they were told, or this is what private equity groups are telling me that we need to see in an asset in order to pay a premium multiple for it. So you want to dress up, refine, and ultimately go to market, and we can teach you on how to do that same process for yourself to maximize an outcome. And then all of that, they need to produce that 2 to 4x return to those LPs. And you guys, the partner docs that affiliate with these DSOs, you too are likely, if not almost always, going to be a shareholder in that parent company. And you want to make sure that you go out and receive similar returns. So this is a great, I think, overview of why they're attracted and what their goals are. And then hopefully this will be useful for the rest of this presentation. So where are we today? So this is an interesting slide that shows dental all the way on the right. Of all these private equity-backed healthcare sectors, on the far right, you've got OBGYN, middle of the world of this, you've got ear, nose, and throat. And then on the far left, you've got dental has over 20 platforms that have a greater than 5-year hold period, and 17 that have a greater than 7-year hold period. And we watch this very, very closely, because all of these platforms have told those limited partners that they should expect that 12 to 18% compounding annual return on average around 5 years. So every year beyond 5, they're on above average hold time, which is not great. They want to see liquidity ideally before the 5-year period. And then anything beyond that, people start to get a little bit squirrely. And the original folks that founded the organization have to take a lot more phone calls from their limited partners at this stage than they do, in years 1 through 4. So what that means is there's a large swath of platforms that need to ultimately sell in the next year to 2 years to keep their limited partners and doctor partners happy, which is a good thing for anybody that has not sold yet, because it could line up to create an environment that is incredibly seller centric if a few other things go right, which we'll cover next. So healthcare services, PE, this is like a number of transactions or recapitalization events, DSOs successfully recapping by quarter. And something to call out here, Q4 of 2021, probably will never be reproduced ever again. It was just a perfect storm where you had a huge pent-up demand from 2020, and then you had a very, very aggressive, negative tax implication for sellers if they waiting for them in 2022. So you had a huge supply of people that wanted to get their deal done in 2021. And that's why the fourth quarter was as crazy as it was. It was just like perfect alignment of buyers and sellers wanting to get deals done. And money was very, very cheap back then. Interesting point here. We had a webinar probably this time last year where we were saying that 2024 was going to be an amazing year, and overall our outlook on 2025 was very rosy. We really thought that this was going to be the year. And actually, starting in Q1 of 25, we actually did better than we did in Q1 of 24 from a count perspective. And we actually did better than Q1 of 23. So we actually were bucking the trend and started 24 better than we had the prior 2 years. However, April 1st is when the tariffs were announced. And as a result, you had this huge slowdown, if not screeching halt of healthcare M&A. So that's ultimately why in aggregate 25 it might be down from 24 by the year end, but it's largely because of what happened with tariffs. That has mostly, if not all the way played itself through, I guess, the analysis phase of all of these groups. And now it's just a matter of like, if inflation comes through as a result of these tariffs, then, we ultimately might feel some pain, but hopefully the analysis phase of them to come to terms with it is behind us, and we'll see a nice rebound in Q3 and Q4. But what are some of these things that I had mentioned before that need to align for us to have a really hot market again? So starting with interest rates, we did finally get an interest rate cut last week, which was very welcomed news for us in our seat, and hopefully all of these existing platforms and private equity groups that are looking to make investments in the dental space. So if we do get another 2 cuts by the end of 2025, you're looking at a potential target of 3.5. That's pretty aggressive, but 3.75 certainly feels achievable. As the last cut was a quarter point, so now we're around 4.25 for the Fed rate, and to 3.75 by the end would be really nice. And it actually, if you want to kind of compare it to the high of 2019, it still wouldn't even be at the height of 2019. 3.75 would still be about a whole percentage point higher than where interest rates were in 2019, which at that point in time was the hottest market for dental M&A. So that makes us feel really good, because there's actually still an opportunity for it to go down. Additionally, inflation trends, we didn't see the greatest news out of the Fed announcement with respect to inflation. It's not where they want it. They want it, in the 2s, and it's closer to 3 right now, which is not where they want it, but they felt based on the labor market news that it was okay to cut. So their concerns shifted away from inflation and more towards labor. If inflation doesn't get under control, we won't get those 2 cuts. So we need to be cognizant of that and take that into our calculus. But if these things align with this large swath of buyers that need to recapitalize, there's an opportunity for some of them to go on a buying frenzy before they go to market. And that's where, there's an environment for our clients to get, the best possible outcomes. So that's quick overview for me. I'm going to hand it off to Connor, and he's going to really roll up his sleeves and talk through some specifics on what you all can be doing within your own businesses and how to look at your own business in the eyes of a buyer. And then hopefully we'll have some time to do some Q&A together. But Connor, I'll let you take it over.
All right, thank you, Ryan. Appreciate it. Definitely a lot of good information, and hopefully positive trends coming our way here in the next 12 to 18, 24 months. And a lot of you folks are sitting on the call and saying, as we see this next wave of consolidation and dental M&A, how are you going to be able to take advantage, and how are you going to be able to win in this next phase, as a lot of these groups are ramping up to really provide a great outcome for not only their limited partners, but their partner doctors as well. So I first like to really reiterate the benefits of a DSO partnership. And when I say DSO, I'm saying DSO, DPO, OSO, SDPO, whatever acronym you want to use. But at the end of the day, a DSO has really 2 functions for a partner doctor. 1, operational benefit, and 2, financial opportunities. And when you look at the operational benefit to a partner doctor, first and foremost, it's a work-life balance. I can't tell you how many doctors we talk to that say, like, look, I love what I do, but I hate how I'm doing it. I'm spending too much time in the practice, too much time on the admin work. And these DSOs are really there to support you from an administrative standpoint and help you with that work-life balance, so that they're taking over marketing, HR, revenue cycle management, accounting, payroll, procurement, you name it, right? All of the administrative back-end services they want to support from their expertise, but they also want to help your team grow and develop, right? They want to help empower your team to really focus on what's important, and that's providing the best patient care possible. But then you, as the doctor, get to be in a collaborative environment and community. So many doctors we talk to say, I feel like I'm on an island, because everything ends with you at the practice in a private practice setting. But when you can be in a community of like-minded doctors and collaborate and support each other, it's really a rewarding environment to be in. And ultimately speaking, these groups are never going to really dictate your clinical expertise and your clinical philosophy, and they should not be touching whatsoever from the clinical side. Just again, alleviating a lot of the burdens of owning and operating so you can truly focus on what's best for the patients within your practice. But then additionally, there's an incredible wealth creation opportunity for a partner doctor to join a DSO setting. You absolutely can have generational wealth in these transactions, and we've seen it with our clients in the past, but it also allows you to mitigate your risk and not have all your eggs in one basket. And you can diversify where your risk is, take some chips off the table, but you also have the opportunity to retain ownership in your practice. And I'll get to that here in a couple minutes, but depending on the deal structure you choose in the equity position, you can absolutely retain ownership within your practice and then leverage the economies of scale and centralized services that these groups have that makes your business far more profitable that then you're participating in. And ultimately, every business owner and every dentist is going to have to exit their business at some point. And this provides you with that secure exit strategy to find not only the right partner that's a cultural fit and a financial opportunity, but again, eventually find the right partner for legacy planning and exiting the business overall. Now, it's important to identify the different types of doctors that are really going to be able to exceed in this coming market and kind of the vision we have in 2026 and what we're seeing coming together perfectly. And we really group it into three specific buckets. First being an exit planning doctor. These are docs that are typically towards their end of their career, kind of sunsetting. Their career might have 5 or 7 years left. Historically, have a really strong track record, both in the financial aspect of the practice, but also really strong reputation within the community. But you're looking to maximize your value. The DSO transaction value is far greater than a private practice sale. And it's sometimes, 200-300% of collections if you're comparing apples to apples, if not more, in how you can actually monetize your business. But it's also allowing you to transition the legacy of your practice where these buyers and these DSOs do truly care about the legacy and the longevity of your business and continuing that even when you are exited from the practice. The second group of doctors being the fatigued doctors, the ones that are saying like, look, I can't focus on clinical care and I'm just overwhelmed with the operational aspect of things and I want to start refocusing on patient care and the things that I'm truly passionate about, right? And so these DSOs truly are trying to leverage their centralized services, their expertise to alleviate the administrative headaches so that you can focus on patient care. Again, you can take some chips off the table and diversify your financial position, but not be so burnt out, right? You can again focus on what you truly are passionate about, what you care about, which is providing the best patient care possible. And then third is the entrepreneurial partner. There are more and more doctors that are coming to Tusk and saying, look, I've got this great business, I've got 15 years left, I've got 20 years left, but I want to leverage a group that is focused on growth and I want to leverage their capital and their expertise and their economies of scale so that if I have 3 locations today, I want to grow to 5, 6, 7, but I don't want to do it all on my own, right? I can leverage the group's HR team to be able to recruit hygienists and doctors and team members, or I can leverage their team to focus on new locations or new targets that I can acquire within my local community, but really create a long-term partnership that is mutually beneficial where everyone is winning at the end of the day. Now, these groups are hyper focused on creating alignment with every single doctor that they partner with. Gone are the days of selling the business and walking away in 12 months. They want to make sure that you, as a selling doctor, are truly committed in the long-term success, just as they are in investing in your business. Now, some practices that may not be as attractive in today's market are really those that are, I'd say, either plateauing or negative growth within the business. I'd say distressed practices that just have not been able to rebound post-COVID. And something that we've really seen trending in the last couple of years is provider risk, where you need to make sure that, whether you are the super producer or if you have associates that are meaningful producers in the business, that everyone truly is committed to long-term commitment and staying on board so that that business can continue to grow and scale with that DSO partner as well. Now, alternatively speaking, who are the buyers in today's marketplace? We really bucket these into three distinct types of buyers. One being the, historical, well-known, well-established DSOs, kind of the blue bloods that all of you are familiar with, have heard the names before. Again, folks that might have had one, two, three recaps in the historically speaking, and might be again ramping up for their next process and next cycle of a recapitalization event. But then also, just as excitingly, we've seen a lot of startup groups post-COVID where there's a new environment that they've created their platform to be successful in this new operating environment that we all are seeing ourselves in post-COVID, that has really taken a unique position to provide an attractive support structure for doctors like yourself looking for a doctor-centric group to partner with. Then third, we're still getting called every week from private equity groups that are looking to invest into dental platforms, right? So there is more and more private equity groups and investors that are seeing the historical trends and success of dental and saying, I think that we can invest and launch into a new platform, but we need, as Ryan said, a group that might have $3 to $4 million of EBITDA and centralized services and capability to really launch from. So we are seeing private equity groups again trying to come in to create new DSOs and new platforms regularly. Now, each group is going to have a different flair, a different structure, a different operational system. In today's market, there's well over 120 private equity-backed DSOs that are in today's marketplace, and everyone again has a different structure, but there's really three unique equity positions that these groups offer to the selling doctors. So first and more traditionally is the holdco or the parent company equity position. Think of this as a little more traditional where you're receiving equity in the parent company. Think of it as like an Amazon or a Tesla stock where it's highly illiquid until the recapitalization event occurs, but you as a selling doctor and a partner in the organization are aligned through the parent company. So whether you're in Texas or Florida or California or Minnesota, you're aligned with all the other partner doctors for the success and growth of the overall platform you joined. And this is again where that term, the second bite of the apple, comes into play, where you're participating in those equity returns when the organization does go through a recapitalization event. You're able to monetize your equity anywhere from 2 to 4x returns in what that looks like. Now, your timing may be a little off, where if you join a group that's recapitalizing in 12 months, you may not see a return as high as a group that you join that's recapitalizing in 4 years, right? So it's all about the risk profile and the risk appetite that you have, but still having a meaningful equity return with that partner. Next being joint venture. This is again where you have retained ownership in your practice. So you might sell 60 or 65 or 70% of your practice to this DSO partner, but then you're retaining 30 or 40% equity within the four walls of your business. Now, this is really attractive for doctors because you are paid distributions through the growth and profitability of the business. So it really provides a true alignment between you and this DSO partner to help grow and scale and be more efficient and be more profitable. Then again, long term does help with income repair, and oftentimes we'll see clients making more money post-transaction in the joint venture structure than in a private practice setting because of the support and opportunities that these DSO partners bring in a joint venture structure, but does truly create a long-term growth strategy for not only you, but also future doctors that might want to have some minority ownership in the business as well. And then the third being is a hybrid option. So the hybrid is both a collaboration of joint venture and holdco equity positions, where you can diversify your buckets of equity. So you can kind of put some money in the holdco where you can participate in that parent company recapitalization event, but then also have retained ownership. So you're getting distributions, whether it's monthly, quarterly, or annually, again, which is a very attractive position. But it provides you with kind of the best of both worlds, where it gives you that upside value and potential in the holding company, but also allows you to plan from your legacy and sell some ownership to associates that might be key players within the business itself. And really, in our world, when we represent clients to go to market, we want to bring a variety of different DSO partners to the table. Oftentimes we'll have over 15 unique buyers that are participating in the transaction and meeting with our clients. And we want to bring holdco, we want to bring joint venture, we want to bring hybrid options, so that you as a seller have the most confidence knowing that you've seen every potential structure available to you, but now you've been able to select what's truly the best fit for you, for your team, for your patients, and again, your eventual exit within the business itself. Now, as Ryan had alluded to earlier, we are certainly seeing a lot of headwinds from the last 2 to 3 years quickly starting to turn into tailwinds for a lot of our clients and the buyers. We're seeing a lot of positive momentum in the marketplace, and the momentum is only starting to pick up again in 2026. And really, it's more of a matter of how are you going to be able to take advantage of this if you are considering a transition or a partnership in the next year or two, to not only maximize, again, your financial outcome, but have the right partnership long term as well. So, from your perspective, how are you going to be able to really win in 2026? So, first and foremost, as Ryan had said, we are seeing an immediate interest rate environment that is more attractive. It is going to be continuing to improve. So, as the interest rates continue to cut, we're seeing the investment committees, the private equity firms, being a little more lenient in the transaction value, because the debt service is not so high in a higher interest rate environment. Second being, these DSOs have been actively retooling their teams to provide really a platform to immediately go out and start acquiring as the market again is starting to show some of these positive trends. So not only are they really creating a focus on new team members that are coming on board from an M&A, corporate development, operations team, but they've also focused the last, let's call it 2 to 3 years, on organic growth and operational efficiencies. So they are again retooling their organizations to focus on acquisitions here in 2026, because they just spent the last 3 years really optimizing their operations. Again, whether it's through technology, whether it's through team members, whether it's through added procedural mixes or specialties. Again, they are focused on acquisitions here moving forward in 2026. And they've also seen a normalization of the new operating environment. We have all seen a challenge in, the Great Resignation and team members and retention within practices and how to recruit and bring on board. But again, these groups have been able to really focus what the new normalization is and the new environment is, and gotten comfortable with that and been able to pivot to be successful in the environment. So they are again focusing heavily on M&A in 2026. But then, as we said, recaps are occurring, and it's driving a lot more confidence in the marketplace. So we saw a handful of recaps in 2024, although limited, we did see them. We have seen more recaps in 2025 than in 2024. And there's a lot of groups that are again in the process right now and likely closing their deal in Q1 and Q2 of 2026. So there's this huge trend of recapitalization events occurring. And now, again, as a seller, you're kind of looking at your opportunity in your business and saying, hey, if this group is going to recapitalize towards the end of 2026, am I going to be able to participate in that recap today, or am I going to have to wait for the next cycle? Or if they're going to recap in 28, maybe I can have a couple of years of growth in my equity and then be able to monetize my equity in a couple of years. Certainly, again, gives you both options as you're considering a transition. And then, as Ryan said too, in April 1st of this year, tariffs really impacted the M&A world, and it made some of these private equity groups kind of hunker down a little bit and kind of see how it all shakes out. So now what we're seeing is these private equity groups are baking in tariffs and those impacts into their modeling and projections for their limited partners. So now it's not a surprise, rather it's being part of the part of the financial outcome, part of the modeling that they're leveraging and utilizing to be as transparent as possible in their future earnings for limited partners and doctors as well. So, what are some of the more internal drivers that are occurring in today's market that are going to have these buyers again coming from maybe less aggressive and hunkering down to again back to the table of acquisition? So, first and foremost, as I said, these DSOs were originally created to grow aggressively through acquisition. Every group wants to grow organically. They want to focus and leverage on efficiencies, economies of scale, top line revenue growth. But you can only grow your business so much, as many of you have seen in your history and your experience in being owners, where they need to grow through that 13 to 20% compound annual growth rate through acquisition. And if they haven't been making these acquisitions, they need to start really ramping up and being more aggressive through acquisitions, which again, we're seeing at the end of this year and into 2026. And then as Ryan showed before too, there's over 40 DSOs that have reached and exceeded that 5-year holding period. So they are feeling some pressure from their limited partners to start the process of going through their recapitalization event. But also what we're seeing is some of these groups that are planning to go to market in Q1 of 26, they're trying to bring on as much EBITDA as possible because they might have already been able to hit their financial goals, but they're not planning to go to market for another 6 to 12 months. So every incremental dollar of EBITDA is going to be that much more beneficial for the limited partners and the doctors within the organization. So think of it as acquisitions that are kind of the cherry on top. So this is also creating a very competitive environment and aggressive offerings to some of these doctors when you have a group that is already there financially, but they're just trying to add more value, more EBITDA to their organization as a whole. And then we're seeing really this critical mass in specialty that is causing a lot of positive momentum too, where now they're still trying to acquire not only to just get their feet underneath them, but through critical mass and really be able to improve their market saturation, where we've seen some specialties over 50% affiliated, which again is creating a lot of noise and I'd say positive momentum for those that have not partnered or have not sold to a DSO or a specialty group yet. Now, when you really take the external and internal aspects of what's going on in the marketplace, it's creating this perfect storm for an incredibly competitive process, which again, we want to do for our clients. But for you, you are absolutely being rewarded for this competitive process because you have 5, 6, 7 unique LOIs that are actively being negotiated on your behalf, where you can choose from a cultural fit, from a financial opportunity, and put it into the right package that creates the most excitement, but the best outcome for you and your DSO partner moving forward. All right, so the $1,000,000 question, what can you do to prepare and capitalize on this next wave of consolidation and the trends that we're seeing? I say first and foremost today, understand the value of your business. There are so many doctors that we talk to that we honestly work with for 2, 3, 4 years that we're continuously rolling numbers forward and providing insight and guidance on what the value is today, but also different aspects that you can work on so that you truly are the most attractive asset in a transaction when that time comes. So certainly would strongly encourage you to understand what the value is of your business today and how we see it fitting with some of these groups moving forward in the future. But then also determine what path you want to choose. Are you in the situation where you might want to focus on growth for the next couple of years? Or maybe you are ready to partner, you are ready to join a DSO that can eliminate some of the headaches and help you grow through their centralized services and through their economies of scale and their expertise. And then plan backwards. I talk to a lot of our, current clients and prospective clients to say, to maximize the value in deal terms, you need to focus on a minimum of a 5-year employment agreement post-transaction. Now, that doesn't mean that 5 years needs to be at the same clip that you're operating today, working 4 or 5 days a week, but rather ensuring that you're an aligned partner for 5 years. But if we're looking at 2026, if you want to exit the business by 2032, you need to start planning and getting things moving forward as soon as possible and getting your house in order so that you are ready for a successful transaction, but then have that, 5 to 6 year transition period within your partnership. And then consult with your wealth advisor. Whether it's a wealth advisor, whether it's a CPA, attorney, you name it, the advisors that are in your corner, have conversations with them on what your goals are, not just short term, but long term as well. And financially speaking, are you ready for this transaction? We always like to work with our clients to ensure that this is going to ring the bell financially, but create financial independence for you long term as well. And you might already be there. So you could say, well, hey, this is just a cherry on top for me, and it's going to help me de-risk usually my highest net worth asset that is highly illiquid. So you want to be able to, again, talk with a wealth advisor to ensure that you have a success moving forward, that you're prepared financially speaking, but also talk to former Tusk clients. At the end of the day, we always encourage folks that are considering this process to talk to peers to understand what their process is like, because going through Tusk's process is far different than doing this on your own or with another advisor, because of the broad reach that we have and because of the work that we do in ensuring that you are having success long term, not just at the point of sale, but 5, 6, 7 years down the road as well. And then, from a legal perspective, make sure that your business is in order so that there's no landmines when we do get down to the legal diligence of things. Whether it's your real estate, whether it's cross collateralization, if you own the real estate, employment agreements of your associates and your doctors, there's legal aspects that you can really prepare today to make sure that long term, when you go through this transaction, you are in the best possible position. But then ultimately speaking, you want to be first in line. You want to be part of this first group of this next wave to really take advantage of these groups coming back with more capital being readily available for you to be successful. But again, having I would say, an asset that is almost irresistible to some of these DSO partners, and having 5, 6, 7, 8 unique buyers that are actively competing for you to select them versus the other way around. So I would say, wrapping it all up, again, we want to be able to have some time for some Q&A here, but some key takeaways, from a fact pattern, buyers are retooling their teams to really ramp up to be aggressive in their M&A activity. We're getting called all the time from recruiters looking for business development folks, for M&A folks, for corporate development team members. They need to bring on teams to hit the capacity, but also they need to be able to acquire to hit their financial goals that they promise with their limited partners as well. So we are seeing that really ramp up drastically right now. And then, as we've seen last week, and again, hopeful and confident moving forward into Q4, is that there's a lot of pressure from Washington to lower the interest rates, and we're actively seeing that happening. And again, cautiously optimistic on what that looks like. And then the recaps again are occurring. We've seen some deals that have maybe been on pause, but we're seeing more and more deals that are going all the way through closing, more in 25 than we saw in the entire year of 2024. And there are some very, very large, very well-known household names that are just wrapping up their Q of E's and their process through their recapitalization event as well. That is going to be, again, very, very, let's put it, positive for those that are on this call considering a transaction here in the near future. So some of the outlook, again, DSO activity is rapidly trending upwards. We're seeing more and more groups that are coming to us and saying, what do you have coming to market? What do you have in your pipeline? Q4, our investment committee is ready to go, and we're ready to start making aggressive acquisitions again. So we're seeing a lot of activity from the DSO front. Again, as I mentioned, buyers need to make up ground. If they have not been acquiring for the last 2 years in a meaningful way, they need to make up ground in a very expedited way in a very short period of time. So that's, again, going to create a perfect storm for folks on this call that are considering a transition and a partnership. And then really the CFO Pulse survey is looking at some PE alignment and what their priorities are in the second half of 2025. And it's all about regional mergers and acquisitions, looking at how can we make some maybe smaller acquisitions to bolt on to our current platforms. And the private equity firms and the investment committees are absolutely aligned long term with their platforms that they've invested in for mutual benefit, mutual success of a full term benefit, and obviously success for everyone involved within the process itself. Now, lastly, and then I'll jump over to Q&A here, but as I mentioned before, you want to know what is the value of your business today. We probably look at 400 to 500 practices a year, and understanding the EBITDA, the adjusted EBITDA, where there's growth potential, how you can again better position yourself for success. So for folks on this call, I would certainly encourage you and recommend you to scan the QR code here on my screen, or go to our website and submit a request for a practice valuation. We show a really detailed analysis of both of a 5 and a 10-year cash flow scenario, but understanding where your adjusted EBITDA is today, understanding if your business is attractive, and how you can better position yourself for success long term is incredibly important for your future transaction. So certainly would encourage you to submit a complimentary practice valuation, and happy to support you through that, completely confidential. Then with that, with the time that we still have, happy to answer some questions that might be coming through the chat. Ryan, one is coming in here, and I'll hand this one off to you. It says, with the recap news that are occurring, how is this going to be beneficial for me directly in a transaction itself if I'm considering a sale in the next 12 to 18 months?
All right. Good question. So, what does that mean for me if I'm sitting with a business potentially going to market? Well, when there's activity at the top of the market, that is generally very good news for a seller, because if those 20 plus groups over 5 and 17 groups over 7 years in hold period, as those dominoes start to fall and that good news comes through the market and liquidity is then given to those limited partners that took money, doctors are able to liquidate some of their rolled equity. That private equity group's able to go out and perhaps replicate their success in dentistry and start all over again. So the more groups that recapitalize, the greater good news flows through the market, the more liquidity flows through the market, and in theory, that the more seller friendly market that should come through on the other side of that. So what you don't want to happen is no good news, no businesses are recapitalizing. At that point, I'd mentioned at the very beginning, these businesses don't go in a cycle. They don't go in a circle, like come back around. This is a constant ongoing wave that is at different points. And if you're in a trough, what ultimately happens is you want to see it come out of it. And that's where we're at right now. I think that there's plenty of good news on the horizon, that we are going to come out of this trough of downward M&A trends, and we're going to, see a resurgence of that. However, that wave will eventually die. Those waves, you might only go through several of those waves, and then it's going to reach max consolidation, and there will be nobody available to pay the premium multiples that we've seen over the last 5 years, when the cycle is at its next trough, or maybe it's 2 troughs from now. But all that to be said is, it basically shows us that we're coming out of the trough, and there's an opportunity to maximize an outcome for yourself through a highly competitive process. I think that kind of answers that. Is that fair, Connor?
Yeah,
Anything?
no, that's fair. That's a good answer there. I got another one coming in here that says, in your opinion and what you've seen, who is the best DSO in today's market? So I guess the first answer I'll give is, it depends, right? Are you a GP? Are you an orthodontist? Are you a multi-specialty clinic? As we shared before, what is your goal? Are you looking to exit? Are you looking to grow? Are you looking to focus on clinical care? So I think the answer
What
is,
kind of deal structure do you want? Because not all DSOs offer the same structure.
spot on, exactly that. And that's again where I think understanding what your goals are in a transaction is incredibly important. But in the last, I'd say 18 months, we've closed deals with 20 unique buyers. Now, we typically will have many, many more buyers, but we've closed deals with 20 unique buyers. And because the deal structures are so complex and so unique, and there's, 20 to 30 deal terms that are actively negotiated on your behalf, what you like to see in a DSO or in a partnership may be completely opposite of someone even down the road from you, right? And so that's where, I'd say that our job is to make sure that we're bringing as many potential buyers to the table so you do truly see all of the opportunities available to you so that then you can select who the best DSO is, for your, again, financial goals and your equity structures and ultimate exit within the business itself. Um,
Yeah, well said. Yeah, I think that pretty much covers that one.
Perfect. Well, I see a handful more questions coming through. I do know we're getting at time here, so like Ryan said, we are more than happy to reach out to people directly, with addressing some of the questions you may have, but also again open to have any type of confidential conversation about your situation specifically. Certainly appreciate you all for joining us here this evening on the webinar, and looking forward to a great 2026.